Integration of financial statement analysis techniques. This reading has two sections. The first section is an introduction section in which we will review the financial statement analysis framework recommended by CFA Institute. And then in the second section, we will go over a case study where this framework is going to be used to evaluate a long-term equity investment. First, let's talk about the framework. This is something that goes back to the very first reading at level 1. There we were told that during a financial analysis, you need to follow a certain framework, and CFA Institute recommended a framework. Now in the final reading, that framework is being reproduced. So we'll talk about this framework very briefly, and then we will apply this framework in the two case studies that we will discuss. So the first step is to articulate the purpose and context. So why are you doing this analysis? What is the purpose of this analysis? And the output from this phase is your objective or a set of questions that need to be answered. Then step 2 is to collect the data. So based on the type of analysis you need to do, you need to collect data. If you are deciding whether or not to buy a particular stock, then obviously you need the financial statements, the annual reports. Maybe you will need other information, but in our case we'll keep things simple, and just when we are analyzing Nestle in case 1, we will need to use the annual reports of Nestle for the last several years. Then we process data. So we need to make adjustments when needed. So if you are comparing a company that follows IFRS with a company that follows US GAAP, then obviously adjustments need to be made so that you are comparing apples to apples. You might need to create common size statements. You might need to create ratios. And then you analyze and interpret the processed data. Very often these two steps happen together. In fact, you will notice that in both case 1 and case 2, these two steps are merged together, because as you are creating ratios, you are also then analyzing whether the ratios represent something good or something bad. Then step 5 is to develop and communicate conclusions and recommendations. So based on your analysis, you are deciding whether or not to buy the stock. At times, the decision might be to hold the stock, but maybe at a relatively low weightage. So earlier you might have had a stock that is 30% of your portfolio, and you decide that you want to reduce the weightage from 30% of the portfolio to 20% of your portfolio. And then there is follow-up. So once you made a decision and taken an action, you don't just sit there. Every quarter, or maybe once in 2 quarters, you go back and evaluate your decision, because the markets change, circumstances for a particular company can change. So you go back and assess whether the decision you made 3 months ago or 6 months ago is still valid. So this is the basic process. Let's move to case study 1, which has to do with a long-term equity investment. Phase 1, as I said, is to define a purpose for the analysis. The purpose of this analysis with case 1 is to determine whether to make a long-term investment in Nestle's stock. Before making this decision, the analyst wants to address the following questions. So the bigger picture here is that there is a portfolio manager, and this portfolio manager has asked an analyst to evaluate whether to increase the portfolio's holding in Nestle or to decrease. So most of this work is being done by the analyst, and you are learning from this analyst how to evaluate a company like Nestle. So the types of questions that the analyst will be concerned about are shown over here. What are the factors that have driven Nestle's financial success? Are these factors sustainable? Now, sustainability is very important when you are making a long-term investment, because if a company has excellent profits, but those profits are not sustainable, then this clearly is not a good long-term investment. Then what are the risks that can impact the sustainability of Nestle's return? Anytime you are making a long-term investment, you also need to understand the risks involved. So this is phase 1. These are the questions that have been identified. So now the analysis will be around answering these questions. But obviously before the analysis, we need the data. And here the analyst goes to the website, Nestle's website, and gathers the annual reports for the last several years. All right. Then, as I said, phases 3 and 4 are merged together. processing the data, and then analyzing the data really go hand in hand. In this particular case, here are the things that our analyst will do. He'll do a DuPont analysis, then he will do an analysis of the composition of Nestle's asset base. So these items actually come straight from level 1. The asset base analysis will be based on a common sized balance sheet. Then he will look at the capital structure. Next step is to study the company's segments and the allocation of capital among them. Ideally, you would want that segments that are performing very well should have a relatively high allocation of capital. Then there will be an examination of the company's accruals in reporting as they affect earnings quality. This connects with the reading that you just did, where you are concerned about earnings quality. High earnings quality means that earnings are sustainable. So clearly, if you're making a long-term investment, you want to know how sustainable the earnings will be. Then there will be a study of the company's cash flows and their adequacy for the company's continued operations and strategies. Finally, we'll do a decomposition and analysis of the company's valuation. So let's do this DuPont analysis first. What happens in a very basic ROE analysis? So what's ROE? It's net income divided by the equity. When you are making a long-term equity investment, does it make sense to look at this ratio? Yes, it does, because you are putting your money equity and you want to know what sort of a return you are getting. If we look at the return on equity from 2012 onwards, so for the last 3 years, this analysis is being done at the end of 2014 or early 2015. Do these numbers look good? So ROE was about 17% and then 16.5 and then going up to almost 22%. These numbers look quite good. And here there was a slight decrease, but overall trend is upwards. So this looks good. But we want to try and understand what are the components of ROE. Perhaps these high numbers are coming because of leverage. Perhaps these high numbers are coming because of investments in associates. So we need to drill deeper. But before we do that, let's recognize from level 1 that there are 3 different ways of breaking ROE. One way is to simply say it's return on assets times leverage. So this is a refresher. Return on assets was net income over assets, and leverage is assets over equity. So the assets cancel out. What does this tell us? This return on assets is a measure of how operationally efficient the firm is. How much money does it generate against its assets? So ideally you would want a high number over here. This is something we look at. Then return on assets can be further broken into net profit margin times asset turnover. So net profit margin is net income over revenue. Asset turnover is revenue over assets, and leverage is assets over equity. So here the revenue cancel out, assets cancel out, so you have net income over equity. Now this is talking about how efficient the firm is in terms of net income from revenue. This is telling us how efficient the firm is in terms of usage of assets, and then this talks about leverage. If the leverage is high, then all else equal, the ROE will be high. But if the ROE is high because of high leverage, that's not very sustainable. And then net profit margin can further be broken into these 3 components: the EBIT margin, tax burden, and interest burden. Okay, now just a few points before we look at some more numbers. So we want to keep the analysis logically consistent. What does this mean? When we look at the financial statements over the last several years, we realize that certain accounting rules kicked in or were changed in 2012. If we are looking at numbers from 2011, these are based on earlier versions of these accounting rules. So what do we need to do? We need to go to the 2011 numbers and adjust them based on the new rules so that we have an apples to apples comparison. Also, there might be impairments and other charges that are not sustainable. So we need to also evaluate those charges. We also need to consider the impact of associate companies. This is something we've seen at level 2. If you have associate companies, then you use the equity method. With the equity method, you simply have a single line on the income statement. So you consider that one line which makes your profitability ratios look better than they actually are. Because the revenue doesn't go up, it's only the net income that is going up, so your ratios look better than they actually are. So we need to consider that impact also. All right, now let's look at this DuPont analysis. These few lines talk about the decomposition of net income over revenue. And notice that here we have the net profit margin excluding associates. So I want to emphasize a point over here. If we look at what's happening at net profit margin without considering the associates, and actually just to point something out, the case tells us that we are evaluating Nestle, and Nestle has a major investment in a company called L'Oreal. That investment is being treated as an investment in an associate, which means that the equity method is being used. So when we come up with this net profit margin, we want to see what's the net profit margin of Nestle alone, which means that we remove the impact of L'Oreal. When we do that, we see these numbers. Notice that the trend is downwards. So when we remove the associate, then in 2012 we had a profit margin of 10.5%, and that's down to only 7.5% in 2014. So these numbers don't look very good. When we do include the associate, so this is the overall Nestle, the reported numbers, they look much better. But the fact is that Nestle doesn't really have control over L'Oreal. So when we are evaluating Nestle management and Nestle as a company, we need to look at what Nestle alone is doing. That picture doesn't look so great. Something else now, if we look at ROE for Nestle only, so this was just the net profit margin. Now if we look at return on equity, here also the trend is down. With Nestle only, we went from about 18% to 17% to 15%. So here also the trend is down. So what's a major lesson here? A major lesson is that just don't take the high level ROE. If there are investments in associates, you need to remove that impact to see how the company itself is performing. All right. Then we also need to look at adjustments or provisions and any impairment charges. So the net profit margin in 2014 was quite low. So the analyst now wants to understand why that profit margin came down. So when he started looking at the annual reports, he noticed that there are several goodwill impairment charges. And in 2014, there is a particularly big impairment charge. Now, impairment charges don't necessarily happen every year, so it's not something that is going to consistently happen. So what he does is, he figures out the net profit margin excluding the associates and unusual charges, where he treats this goodwill impairment as an unusual charge. And then he comes up with a somewhat higher net profit margin of 10.62. But even when he removes the impact of this impairment, we still have a downward trend. So despite the fact that goodwill is gone, we are still going from about 11% down to 10%. The difference is not as much as what we had over here, but still the company is not doing as well as we might think when we just look at the high level ROE. What's the lesson that you get out of this? The lesson is that not only do you try to remove the impact of associates, you should also do an analysis removing unusual charges and see what happens. The next action is to do an asset base decomposition. So what's going on here? Notice that what we have here is a common sized balance sheet, something that you studied at level 1. So in 2014, the analyst is looking at every asset as a percentage of total assets. So cash and equivalents are 5.6% of total assets. Then we have other short-term investments, inventories, trade and other receivables. So total current assets represent 25.5% of all assets. And then we have property, plant and equipment, 21%, goodwill 25%, intangible assets 14.8%. Now, this seems a little strange. With a company like Nestle, which is manufacturing food-related products, the analyst is a little surprised to see that intangibles like goodwill and then other intangible assets represent almost 40% of all assets. So this is concerning, but it also points towards a strategy that is very acquisition based. Where do you get this much goodwill? You get this much goodwill when you are acquiring companies. So based on this analysis, the analyst figures out that Nestle's strategy is based heavily on acquisitions. So then he studies this in a little more detail. He looks at Nestle's investing activities. And here I'm not going to go over all the numbers, but the important point is the bottom line. When we look at acquisitions as a percentage of total investing activities, this is 69% over the last 3 years. So it was, the investments were very high in this year, a little lower in 2013, but then back up in 2014. So this confirms what the analyst figured out on the previous slide, that Nestle's strategy is based heavily on acquiring other companies. Then the analyst moves towards a capital structure analysis. I did not highlight this before, but when he did the DuPont analysis, one line item was leverage. So over the last 3 years, these are the leverage numbers. Leverage is basically assets over equity. So these numbers are not changing very much. And in fact, they are going down a little, which is a positive sign, which means leverage is decreasing. But this analysis is not enough. It's just the top level. You also need to dive a little deeper into how the capital structure is changing. What is happening to liabilities relative to equity? So what he notices here is that in 2011, long-term financial liabilities were 7.8%, equity was 74.2%. Over time, the long-term financial liabilities are going up and equity is going down. So equity is 71.5% of total capital, and the financial liabilities and other long-term liabilities are becoming a higher percentage of the capital structure. So in that sense, the company is becoming a little more risky. Then the financial analyst also looks at the current ratio, the quick ratio, defensive interval ratio. So all these are ratios that you've studied at level 1, and by and large there is not really much reason for concern over here. Then we move to a segment analysis and capital allocation. Looking through the financial statements, the analyst sees these segments and then the sales for those segments and the percentages. So European sales represent 16.6% of all of Nestle's sales. So looking at these segments, the analyst is a little concerned. What's the issue he sees? The issue is that segments are defined over here based on geography and then here based on business. So it doesn't make a lot of sense. If the analyst wants to see how the company is doing in Europe, so there is Europe, but then Nestle Waters might also sell in Europe. So it's not a very clean separation. Ideally, either you have a geographic separation, so you can see how the company is doing in different parts of the world, or you have a separation based on business. So they've sort of mixed it together, which makes it hard to understand exactly what's happening. But nevertheless, the analyst goes with what he has, and this is the life of an analyst. You have to go with the information available. So he decides to evaluate these segments in a little more detail. Now, how do we do a segment analysis? We look at the different segments, and one of the first things we want to do is understand the profitability of each segment. So Nestle Nutrition has a relatively high profitability of 20.77%. The profitability metric being used is the EBIT margin. Ideally, what the analyst would like to see is that if a segment has a high margin, then the capital allocation should also be high. But what he notices is that the capital allocation is only 0.39. So let me just explain where this 0.39 is coming from. The first ratio we take is the ratio for capital expenditures. So with Nestle Nutrition, we are going to take 363 divided by this total capital expenditure. So this is, let's just call this ratio 1. And then ratio 2 will be this number divided by the total. So that's ratio 2. And then 0.39 will be ratio 1 divided by ratio 2. So we come up with 0.39, which is a low number. The immediate concern is that the division that seems to have the highest margin is being allocated a relatively low percentage of capital, which seems counterintuitive. So the analyst is concerned. Now what compounds his concern is the fact that Europe, which has a relatively low margin, so of all these, Europe is the lowest. Nestle Waters is really small, so we will ignore this for now. But Europe, which has a low margin, has a very high capital allocation. So doesn't make sense. Then the analyst says that perhaps these numbers are based on operating profits, which are accrual based. Let me look at the cash flows. These two columns are based on what we just saw. We have the EBIT percentage, which is from the income statement, and then we have the capital expenditure percentage to asset percentage. But here he's doing a segment cash return on average total assets. So he's seeing how much cash each segment is generating divided by total assets. What he would expect is that divisions or business units that have high ratios here, high cash generated for assets, should have a high allocation of capital expenditure. And here he is happy to note that Europe has a relatively high cash return on assets. So this actually explains why Nestle is allocating a larger share of the expenditure to the European operation. The next topic is accruals and earnings quality. So the analyst wants to figure out what percentage of the net income is sustainable. And the high level picture here is that if most of the net income is coming based on accruals, then that's not very sustainable. Whereas if most of the net income is coming because of actual money being received, then that's more sustainable. There are two ways of coming up with accrual ratios, and I'm going to explain this. One method is called the balance sheet method. So with the balance sheet method, you come up with the accrual ratio based on the change in net operating assets over a year divided by the average net operating assets. So the idea here is that if your net operating assets, such as receivables, are increasing a lot, that means that there is a substantial amount of accruals. So the higher the accruals, the higher the change in your net operating assets. So if this ratio is high, where your accruals are high relative to your average net operating assets, that means a substantial part of the net income is based on accruals, and that would imply that your net income is not very sustainable. Now the next question is, how do we come up with net operating assets? What we need to do is, for 2014, we come up with the net operating assets at the start of the year and end of the year. Start of 2014 is the same as the end of 2013. So how do we come up with net operating assets? Net operating assets is your operating assets minus operating liabilities. Operating assets in this case are total assets minus any cash and short-term investments. So if a company has invested in, let's say, stocks and bonds that are not related to the company's operations, then those investments and any cash the company might have are considered non-operating. So the quick way of coming up with operating assets is taking total assets and then subtracting cash and other short-term investments. So this number here represents the operating assets. Then we subtract operating liabilities. Now, operating liabilities will not include long-term debt. So any interest-bearing liabilities are not included, but other liabilities such as accounts payable are considered operating liabilities. Now, the net operating assets will be your operating assets minus operating liabilities. So that's how we come up with our net operating assets for 2014. We use the same process to come up with the net operating assets for 2013. These numbers are numbers at the end of the year. So what was the balance sheet accrual for 2014? This number 5380 represents the change from 2013 to 2014. So this is how much was accrued. This number is the average. So 81519 represents the average of these two numbers. The accrual ratio is 5380 divided by 81519. Now you can see that the accrual is a fairly small percentage of the overall average operating assets. So that number is only 6.6%. You can also see that over the years, so this was 10%, then it went down to minus and then went back up. So this is not a cause for concern. What this is telling us is that the earnings quality looks pretty good. Most of the earnings are coming based on actual cash. Now let's come to the other type of accrual ratio, which is based on cash flows. And this is actually more intuitive. Here we look at this ratio divided by the average net operating assets. So the denominator is the same in both ratios. The numerator is different. Now this numerator is basically saying that we have net income minus the cash flow from operations and cash flow from investments. So you can think of CFO as your regular cash flow from the operations of the company, and then this is the cash flow from investments. So these two numbers combined represent the actual cash being received by the company based on either selling its products and services or selling maybe equipment. The difference of these two numbers represents the accrual. So if your net income is 100 and the combination of CFO and CFI is 90, then the accrual amount is 10. So we are looking at the accrual amount divided by the average net operating assets. So if this ratio is high, that means that the level of accruals are high. If this ratio is negative, that would mean that net income is actually lower than the sum of the two cash flow numbers. So when we come up with the cash flow based accruals, again, there is no real cause for concern. So we had 12.4% in 2012, which was perhaps a little high, but then we came down, and then in 2014 we are at 4%. So at the end of this analysis, our analyst concludes that the earnings quality is pretty decent. So the earnings are sustainable. So he is pretty happy with what he has seen over here. Then he moves on to some cash flow relationships. Here he's looking at the cash generated from operations relative to operating profit. And he notices that this trend is also positive. 1.58 means that the cash generated from operations is 1.58 times more than the operating profit. And these numbers over the years are going up. So again, this is a positive sign. What would be a concern? A concern would be if these ratios were less than 1, that would be a concern. And if the numbers were going down, that would be a concern. But here again, he's happy. Then he looks at cash generated from operations divided by average total assets. So the overall efficiency of the assets, how well are the assets being used? And here there is cause for concern, because in 2012 the number was 15.5%. Then the number went down and it went further down in 2014. So here there is some concern because the cash return on total assets is going down. Alright, some more ratios related to cash. Cash flow to reinvestment. So this is how much cash is the company generating divided by the money that the company is reinvesting in the business. That ratio of cash flow to reinvestment in 2014 was 3.98. So if we round this up to 4, what this is saying is that the amount of cash being generated was 4 times more than the money being reinvested. So this is quite healthy. This is saying that the company is generating enough cash to reinvest in the business. So the number in of itself is good, and also the number is going up. So the company's ability to invest in itself over the coming years seems good. Cash flow to total debt. So this is saying how much cash is the company generating divided by total debt, and that ratio is almost 80%. Again, this is a good number. It's saying that if the company's debt is 100, the company is generating almost 80 every year, which is positive. And then finally, cash flow interest coverage. So this is how much cash is the company generating divided by cash interest payments. And that is 33.2, which is also a very big number. So from a long-term sustainability perspective, the company seems to be doing well. Right. Decomposition and analysis of the company's valuation. Now, I mentioned at the start of this case that Nestle has a major investment in L'Oreal. Now, when we come up with the PE multiple, one easy thing to do is just to take the overall market value of Nestle and divide by the earnings of Nestle. But when we do that, we will also be considering L'Oreal. So what our analyst wants to do is remove the impact of L'Oreal. L'Oreal is also a publicly traded company. So how are we going to remove the impact? We are going to find the value of L'Oreal and subtract that from total market value. That will leave us with the market value of Nestle alone. Then we are going to take the overall net income of Nestle and remove the income of L'Oreal. Where will we find the income of L'Oreal? Since it is being treated as an associate company, there will be a single line item in the income statement. So we are going to remove that impact. So how do we do this? Now, to make this interesting, L'Oreal's currency is the euro. Nestle's currency is the Swiss franc. So there is some conversion that needs to happen. Here we have some information for L'Oreal. The analysis is being done on 31st December 2014. This is L'Oreal's share price. This is the number of shares of L'Oreal that are owned by Nestle. So where is this value coming from? 18,092 million euro. This is the number of shares held multiplied by share price. So this is Nestle's value of the L'Oreal holding. Then we convert euro into Swiss franc. So in Swiss francs, this is the value of L'Oreal that is being held by Nestle. Then we take Nestle's value. Again, Nestle's value is based on the share price multiplied by the number of shares outstanding. So this is Nestle's total market capitalization. From this we subtract the value of L'Oreal. So the implied value of Nestle's operations is this much. So this is the value of Nestle without L'Oreal. In terms of percentages, we see that L'Oreal represents about 9.4% of Nestle's overall value. The next step is to look at earnings. So for 2014, Nestle's consolidated earnings were this much. From that, we need to subtract L'Oreal's earnings, and then we also subtract any other non-controlling interest, and that leaves us with Nestle's standalone earnings to shareholders, which is this much. Now we are ready to find the price earnings ratio, both with and without the associate. Notice that with L'Oreal, market value divided by earnings gives a fairly high PE ratio. Implied Nestle only. So this is the market value of Nestle only, which we found over here. This is the earnings of Nestle only, which we found over here. So the PE multiple is 15.5. So this is the PE multiple of Nestle only. When we look at Nestle with L'Oreal, then we are taking the entire market value of Nestle, the entire earnings number, and we have a higher multiple. So notice that Nestle alone has a lower multiple. Now it's important for the analyst to compare this multiple with the average S&P 500 multiple, or he can also look at the multiple for the S&P 500, all right, which would be basically the value of the S&P 500 divided by the earnings of all the underlying companies. So he notices that this multiple is at a 22% discount to the overall S&P multiple. So this stock is trading at a fair discount. He'll have to figure out whether this discount is big enough for him to buy. Notice that he saw several issues. So now what does the analyst need to do? He needs to basically summarize his analysis. So what he decides to do in his report is say that here are some points that support the case for investing in Nestle, and then he'll make some points that say why perhaps we should not invest in Nestle. So what is there to support an investment in Nestle? Number one, Nestle has financial stability to fund growth in its existing operations and carry out its growth by acquisitions strategy. The company's current liquidity and cash flows are more than adequate for future operating and investment purposes. The company has low leverage and the capital structure is capable of supporting future operations and strategic plans. These points have actually been taken straight from the curriculum. So this is a reason to invest. Another reason to invest is that the operating cash flows have consistently exceeded the operating earnings, which implies a high quality, so good quality earnings. The ratio of operating cash to operating profits has been favorable, providing confidence in the quality of earnings. Measures comparing cash flow with reinvestment debt and debt service capability indicate strength in financial capacity. So the financial capacity is good. The third point is that decomposing earnings into Nestle only and L'Oreal and considering the respective PE ratios, it appears that the implied Nestle only portion is undervalued, because our ratio here, PE ratio, is 15.5, which is much lower than the PE for the S&P 500. The implied Nestle only portion has a far lower price to earnings ratio than L'Oreal or the market. This finding should be considered an opportunity given Nestle's demonstrated cash flows and low financial leverage. So these were points supporting an investment in Nestle. Now, what are the causes for concern? Although Nestle has significant world-class brands and global reach, its core business has deteriorated in profitability in the last several years, as shown by the decomposition of ROE. So when we did the ROE decomposition, looking at Nestle alone, the net profit margins were going down, the return on equity was also going down. Even when taking into account the unusual items affecting profit margins, core operations still show decrease in profitability. So when we removed the goodwill impairment, we still had a downward trend. The next point, the negative trend also shows in the cash returns on total assets. These have decreased since 2012. The acquisition activities in nutrition and health science product groups do not appear to build on the company's traditional strengths. They do not seem to provide a remedy for the deterioration in the core profitability. Now, I didn't spend much time on this, but I can just highlight the central point here. We did talk about the fact that the company's strategy is based on acquisition. If a company strategy is based on acquisition, then you need to figure out how well the company does with its acquired companies. So when it acquires companies, do those acquired companies perform well or not? Is the company acquiring companies in areas of its strength or not? So here the analyst figures out that this company, Nestle, is known for brands like Nescafe or Milo milk and so on, but the sorts of companies that it is acquiring are not in line with the traditional strengths of the company, so that raises a red flag. The company's priorities in the allocation of capital in making acquisitions are of some concern. Although the nutrition and health science product group and the Nestle nutrition segment show excellent EBIT margins, they rank very low in return on assets. This finding raises the question of whether management is overpaying for acquired companies. And finally, the company's write-down of goodwill from earlier acquisitions may signal ineffective allocation of capital. It is troubling that Nestle has taken write-downs on previous acquisitions while actively making new ones. So the point here is that when a company buys another company, the amount that it pays over the net fair value of assets is goodwill. If the acquired company is not performing very well, then what happens? Then the goodwill needs to be impaired. So when a company is impairing goodwill, that is implying that the company is not doing a very good job of running the acquired division. So that should be a cause for concern, especially given that Nestle's strategy is based on acquisitions. All right, so this is the analysis, and then there is follow-up. So basically, the analyst takes this and presents it to his boss, who is the portfolio manager, and this is what happened. The portfolio manager is surprised by the analyst's findings and recommendations. The portfolio manager is convinced that the purchase of shares is justified because of the discount and because, in her opinion, Nestle is experiencing only temporary issues. She commits the pension fund, so this is the portfolio manager of a pension fund, she commits the pension fund to a cautious less than core investment holding in common stock. So the point here is that she did not say that let's just remove Nestle. She said that okay, we were planning to have X% of our portfolio in Nestle, let's remove that, let's reduce that a little bit. So still hold Nestle, but less than what we otherwise would have had. The size of the holding is less than originally anticipated because despite her enthusiasm for the company, the portfolio manager is troubled by the analyst's observations about the resource allocation within the company. She wants him to continually reevaluate the holding. Unproductive capital spending may be a trigger for eliminating the holding. The analyst is asked to update his findings in the initial research report at each reporting period, emphasizing the quality measures expressed by the accrual tests and the cash flow support of earnings with particular regard to return on assets. So that is it for this particular case. Again, notice that we have covered several points from both level 1 and level 2. So I feel that from a testability perspective, this is quite important. That is it for this reading.